thing which COVID has taught us, that this too shall pass, and it was as recent as just 2 years back, which is why when you had the SIP data come in for the month of February, you didn't see a mass exodus from mutual funds.
So now is the testing time, Aisha. You may look back and say, okay, the Indian retail investor has exhibited deep understanding of equities. For the first time, they felt the heat. Now when markets come back, will they be tempted to lock out? It's like 100 becomes 7, and when 7 becomes 10 again, 10 becomes 7 and then 7 will become 10 again. Will you be tempted to sell out? That's happened in the past. Will it be different this time? I don't know. Bala knows, and that's why we called him here to answer that question. Good morning.
Our first studio guest, so welcome back.
Thank you.
This officially marks, I think, reopen once again.
Yes, reopen for all of us.
For all of us, yeah.
Thank you, Nikunj, and thank you, Aisha, for having me part of the show today. I think the point that you made is, I think this volatility has definitely made people understand that how market can be very vulnerable to the investors, right? The last 2 years, a lot of new investors have come, a lot of millennials have come and tested their luck investing in the stock market. Never seen such a huge volatility in the last few weeks that we have seen. So that definitely has given a lot of learning for people as to how to construct the portfolio, and that's why I think mutual fund play a bigger role. And mutual funds have seen cycles in the last, say, 30 years of the growth that we have seen. Now that is the time I think the investors will also start realizing that coming to the mutual fund, SAP of investing, why asset allocation is important. At the same time, having invested in equity, single stock equity or maybe 2-3 stocks equity, if 1 or 2 stocks goes down very sharply, then what kind of impact it would have on a portfolio? That realization would have come to all the investors in the country, or the first time investors, whether it is HNIs or the millennials or even any youngsters who have put money in the market. So that's something I see as a big positive. But having seen that, I think the sharp fall that we have seen, I think definitely something has not just come for only India, it's shaken the whole world, and nobody had expected. The unexpected, whenever it happens in the market, we do such a sharp fall. But it's also, we have seen historically, after a very such volatility that has come in, it also follows up with reasonably good period of uptick. But having said that, this time whether it can be different given the fact that the macroeconomy is not the same as what we have seen in the past. Today the fiscal is high and current account deficits are moving towards 3.5%. Currency volatility is setting in. Commodity prices is all-time high. Every commodity is an all-time high. Therefore, you need to also look at that from that angle, market trend on that angle, as to whether the volatility is actually short-lived or it can remain for some more time to come.
Bala, let's look at the recent parallel. We always say that history is a reference when you're investing in financial markets. So what we saw in the COVID adjustment was like a sudden death. For 2 weeks and markets were down 40%. And in the next 2 months, markets were up sharply. This time it's like a slow grind. You've not fallen sharply, but it's this grind which is very annoying. So how will this market recovery, whenever market recovers, will be different from COVID? Will it be a U-shaped recovery, or will it be a classic V whenever markets recover?
I think it could be a U-shaped recovery. I think it looks doubtful given the fact that a lot of the macro factors have got changed. In the sense that the commodity prices being an all-time high, definitely I think input cost for most of the industries have changed. Oil price being at $110, and most of them I'm sure would have done the math at the beginning of the current financial year with the oil price ranging between $65 to $70. And now with the average coming about anywhere between 80 to 90 or 80 to 100, then actually I think the whole math I think undergoes a change. Therefore, for economy to have a sharp uptick and post-Ukraine, I think is going to be some challenging, and therefore even company earnings coming back would be of course gradual. I'm not saying no.
So this year is gone. This year we should not expect returns.
I think in the initial first few months, I think the way the market has fallen, there's one thing that has happened in the market. Whatever the concern that was there in the mind of people on excess valuation that was been hovering around for some times, the excess valuation got corrected. I think India in general has outperformed the market. The recent fall has been, of course, brought that back to somewhat at par with the global market. Second is the global investors who have been investing in India. I think for a change, the whole of last year they were the net sellers. So, but almost about $11 billion to $14 billion sell-off that has come from FPI investors. Entire thing got absorbed by the domestic investors. And that being the case, FI of course reverses. FIs are more opportunistic. Whenever see fundamentals of the economy undergoes a change, they will of course jump the gun and start putting money. I think my own feeling is the most trigger will come this year. Most of the domestic investors, the foreign investors who are actually got a lot of money, but not able to actually invest the money anywhere in the world. We have very few markets that are left in the emerging market. India being one of the most stable, highly promising market. That's why I think FII flows will be a big surprise for me in the year 2022.
Bala, what 2020 taught us was that you got to buy the fear. For those who bought the fear were happy up until about a month, 2 months back. But this time around, like you yourself said, the macro dynamics are very different from the COVID outbreak time, right? You've got inflation, you've got high interest rate trajectory, the tide of course will turn. How is it that you make a portfolio which is going to be slightly protected from the macro parameters at this juncture?
See, from a portfolio point of view, there are two is, of course, you played. One, in terms of value style, in terms of investing style, every fund manager have got either growth styles or value style. I think clearly at this point of time, while growth style has done very well, I think one should also look, not ignore the value style beyond a point, given the fact they are deeply in value, they are deep in money, but not performed because everybody was chasing the growth. Therefore, the money manager's point of view, one has to look at that. Second is, from money manager's point of view, clearly the companies that has got a structurally longer term business model, such as IT and few others, they're all structurally longer term business model with the free cash flow generating capability of the companies. I think they all will become a preference. But having said that, from money manager's point of view, while they apply this kind of principle, from investors' point of view, asset allocation will remain as key. And today, fortunately, the mutual funds are providing funds that can cater to the varying needs of the customers in the form of providing a balanced advantage fund where you move the equity depending upon the valuation of the market, whether it's price to book or PE multiples. That money manager has been doing it very efficiently. Therefore, that provides one of the opportunity. Second is asset allocation funds now, of course, now come in, cater to the varying needs of the customers, which are conservative in nature or moderate in nature in terms of risk getting capability or the aggressive in nature. I think the mutual fund now started providing solution-based asset allocation product. Also could be a choice for the investor. Then beyond a point, guessing the kind of outcome that could come on this kind of volatility is going to be a futile exercise for anybody for the matter. I think what could work the best actually is the discipline of investing through the asset allocation methodology, whether you invest in direct equity or debt or through the combination of hybrid funds, all of them will come on the back of the discipline that every investor can bring on the table.
You know, so just to pick up on the point that you're making, that it's time for value. ITC, for instance, has fallen a lot less in this recent fall. Now, ITC has also not moved when the market rallied up until about 3 months back. Having said that, names like ITC, and I'm just discussing ITC in particular, are extremely commodity sensitive. Right? They're also sensitive when it comes to the pinch that the consumers are going to feel because everything around you is going to get so much more expensive. The cigarette business, of course, is a standalone case. But do you invest in names like ITC because they've not moved up in the rally and they've fallen a lot less?
So I think the one has to look at from all these companies from the point of view of ESG. ESG now has become a permanent theme. Whether the market has fallen, not fallen, whether the economy undergoes a change, ESG is not going to change. I think ESG way of investing for most of the money managers globally would only become larger and larger in terms of value, in terms of investing style. As long as it fits the bill of ESG, then naturally the buying pattern on such kind of companies would be large higher, even from the ownership point of view, conviction point of view, from money managers point of view. Even there are companies that are deeply valued companies, but not adhered to the ESG compliance. Therefore, to the extent everyone would actually prefer to own less rather than owning more. Sure. I think that is where I think the approach will be taken by every money manager in the world market.
You know, so what would be some of the sectors or the companies that would fit that bill that you believe with ESG?
I think clearly the service sectors falls in the ESG sectors. I think 55% of the Indian economy is coming from service economy. Therefore, entire service sectors would come under the ESG norms, like leaving aside governance related issues. Otherwise, both on environmental side, I think all will fall in place. And second is sectors like IT, of course, comes in service. There are certain sectors, even within the manufacturing sectors, who have been heavily investing on the future business in terms of sustainability. I think all of them will come, whether it is even auto for the matter, any company is moving towards electric vehicle segmentations. I think they all will fall in that category. But the question is, what the kind of proportion of the investment that they are making, which will make them compliant with ESG from the point of building a sustainable business model. I think there are many companies that have been showcasing their capability. As long as they are able to articulate it nicely, and implement it in action, I think will probably fit in the bill. So ultimately, all investments are made on the basis of the ESG score. There will be, of course, somebody will bet 7 or 8 out of 10, and somebody will 4 or 5. But 5 doesn't mean it's bad as long as they have a clear strategy as to where they want to go in the future, from 5 to say 7. If they have a very clear strategy in a very short period of time, they are able to achieve it, then naturally they also will fall in place.
And we keep monitoring our screens with respect to what's going on in the world of commodities. Now, crude back above $115 a barrel. In this current environment of geopolitical risk, how worried are you about margins being impacted on the back of these geopolitical concerns? What it will do for some of these companies?
I think there are many companies who are heavily dependent on, say, let us take crude. There are companies operating that crude as their input raw material. There are many companies use metals as raw materials. I think all these companies will have some impact. Therefore, one cannot just like that jump the gun and then say all these companies will continue to report good profit, and therefore one has to stay bullish. But only the question would be how far is going to sustain. If it is only a long short term in nature, then naturally fall in such kind of stocks would be an opportunity. At the same time, you need to also understand from the business segment is of 2 points. One is, of course, two categories. One is B2B and B2C. If the B2B, you can of course squeeze on the margins or squeeze on the price and not pass it on to the B2B consumers. Whereas in B2C, the question is how much you want to pass it on, the increase in cost, how much you want to retain. All these things will become a critical decision-making process for every companies that operate in the world. Therefore, one cannot just make an assumption $110, $115 can be ignored by creating a bullish story on the overall stuff, and given the fact it will have a huge impact right from import going up for India, therefore have an impact on current account deficit and input costs in general going up for everyone.
We are not trading at the highest point of the day. We'll put that fat band out to just capture how much we are from the day's high. So Bala, final question. On a daily basis, FI is selling but DIs are buying. If I look at the monthly inflow into mutual funds, it's about 15 to 18,000 crore. But if I look at the daily buying which is coming from foreign institutional investors, that's about 2.5 to 4,000 crore. How much cash do you think is still left with mutual funds? And can they continue to buy 2,000-3,000 crores, $500 million for next 1 month? Is that so much of cash in the system still left?
I would assume it will be, given the fact that I think if you look at the sheer size of the mutual industry, it's about 18 lakh crore. And we ourselves as Aditya Birla Mutual Fund manage close to about 1,27 crore size. Even if you assume the cash level in the books is about 3 to 4%, it's quite a lot of money. That's one of the reasons where you see actually in the equity market, the domestic mutual funds have been a buyer because they're able to move money from one to other very quickly. Second, balance as a category which has grown quite smartly. That of course is not fully invested in equity, only about 50 to 60% invested in equity. The natural incremental money can come into the market because the markets have fallen. So that's why I think I see the mutual funds are becoming large buyers in the market, mainly because of the size of the industry itself now has grown such a huge size. At any point of time, having a 2-3% cash is never an issue.
So it's not like a drying pond where little bit of water is left. You think that's still a pond which has a lot of water in it?
Exactly. I think it's a lot of muscle power, I would say, still remains.
Hello, Bala. Good to have you back in the studio. Thank you for joining us, and feels so nice to have. I mean, it's the first time we're doing the joint show together in the studio, so it's been such a great fun to have you back.
After like 2.5 years.
2.5 years, yeah. Wow. Then nice to be part of the show today, and good to see all of you.
Thank you.
Likewise.